welcome back to Trading 360. I'm Diane King Hall. Time now for the big three stocks, three charts, and three trades. Rick Ducat will take us through the charts, and here to take us through the tickers on his list is Aquiles Larrea, founder and CEO of Larrea Wealth Management. Aquiles, thank you so much for joining us, and it's great to see both of you. Before we get into your trades today, I want to get your big picture take on the market. We continue to achieve record after record. What's your thought on where we stand now?
Well, I think it's very interesting. First off, good morning, Diane. What I think at this particular point is we're hitting new record highs, and it could continue for some time. But then by September, close to October, we'll start to see a little bit of a slowdown, a little bit of pullback, maybe a little correction, as is normal and healthy for the market as a whole. But what we really don't want to see is inflation going up. We really don't want to see unemployment going up at this particular point, because those are the things that would bode badly for the market as a whole.
Okay, all right, let's talk about the first name on your list today. You've got Caterpillar on your list. It's been a slight outperformer compared to the S&P 500. What's your view on where it goes from here?
Caterpillar thinks it's a tech stock at some point, and it thinks it belongs in the Magnificent Seven. But the thing about Caterpillar is people forget infrastructure. Infrastructure is important to this country. We did a bill quite some time ago to enhance our infrastructure because our infrastructure is outdated, and Caterpillar is one of the direct beneficiaries of that at this particular point. We also believe that this company has the ability, it's already gone up double digits this year, but we believe that it has the ability to do another double-digit return in the next 12 to 18 months. Year over year, it's done pretty well, and I believe we're up over 20% this year. So at this particular point, should the market start to go south, Caterpillar is one of those stocks that's going to be a flight to quality. It's going to be resilient, and we should start seeing it growing incrementally, bit by bit. Nothing out of this world, but still a solid, decent return with an excellent dividend.
Okay, all right, Rick, then you're up. Take us through what you notice about this chart for Caterpillar.
A sharp rally off of those tariff news-related lows. You can see here 267.30 was where we bottomed out during that period. Now we are up still about 54% from that point, even though we have backed off a little bit from those highs near 441. The point to which we retreated here stands out, though. If we were to look backward here, 407, this was an area where we had a gap and then high points once again, another test of this resistance area, then the breakout, then that's about where we bottomed out during this most recent phase here. We can see as well, though, that leading into this decline, we saw a bit of bearish divergence on the RSI here during the same period. We can see that price was making higher closing levels. RSI was trending downward, even though it remained in the overbought area. So a bit of a mixed signal there. It did play out to the downside marginally in this case, but now we are more stabilized near that 50 midline. If we were to look at our other studies here, we can see that for now, Caterpillar remains kind of away from too many significant volume node areas. We can see here the one that really stands out close to current prices is around 390 or so, which is quite close to our orange 63-day exponential moving average as well. 392 is where that indicator comes in. So that could be a downside area to watch beyond that 407 mark. To the upside, the area where we have our highs is a volume node. It's also around our +2 standard deviation channel, 2 standard deviations up from that linear regression line here, giving us another potential idea of where to look for resistance lining up with those old highs. That comes in right around 435, 440, around that area.
Okay, all right. Aquiles, I'm going to yield the floor back to you. Any final thoughts you want to leave us with on Caterpillar and a potential beautiful butterfly here before we move on to your next trade?
Well, it's important to remember that Caterpillar can go into slow periods and where the return isn't as attractive as other stocks in its particular sector. But we think versus their competitors, they're well poised to do well year over year. Absolutely.
Okay, so let's talk about the next name on your list. This is FedEx. It's on your list. It's been an underperformer compared to the S&P 500 year to date, but you see some opportunity here. Take us through this one because I'm very curious on what the thesis would be for this.
Well, Diane, you can't have all magnificent seven stocks in your portfolio. FedEx is one of these types. It's a clunker right now. It's been underperforming. So we're looking at it simply as a value play where there's an opportunity to pick this stock up. It's cheaper price and at a high quality versus its competitors. So if you look at the UPSs and the other competitors that they have, we believe fundamentally that the value is there. We're also heading into Christmas right now. Historically, those are the big quarters when it comes to these stocks. This is when they make the most money. We believe that the stock currently is oversold, and we think that there's plenty of room to run on the upside. I would not be surprised if we make 6 to 8% on this within the next 12 months. I think I'm being conservative. It could be a little bit higher, but not much higher from that particular point. FedEx has a lot of room for growth here, and you just have to stay with it and be patient because it's the kind of stock that will reward you as a good investor.
Okay, so this one requires some patience. Rick, tell me what you notice about the chart for FedEx.
Well, the most obvious thing that stands out right away is how range-bound it's been in the shorter term. We can see that we have kind of a similar area of interest here, our April tariff news lows that bottomed out near that 194 level. But after recovering, we pretty much never made it above this gap level. We did make some intraday pushes beyond that level and even one close, but notice that we never quite reached that purple 252-day EMA. We topped out near 240 repeatedly here. Now, today's candle is quite interesting here. We have that very long lower wick and that very small real body, the distance from the open to the close. So we are holding on at our moving averages here. We've got our 21 and 63-day EMAs right on top of each other at 228. So this could be a supportive area to watch out for, kind of sandwiched in the middle of our range here, 215 to 240. You can see 215 is where price bottomed out around that area several times here. RSI not giving us too much of a directional lean one way or the other, right around that 50 midline here. So really quite stagnant right at this moment here. Not really clear signs of any direction right now. So low volatility can often be the precursor to high volatility when one of those two boundaries does get breached eventually here. To the upside, we can see that red line, our area near 240, that's where there's significant volume according to our volume profile study. That would so 240 to 245 or so could be a breakout area to watch. Around this area right now is our point of control near 225 or so. That could be another significant area, and then 215 ultimately to the downside could be the dangerous area for the bulls.
Okay, Aquiles, I want to yield the floor back to you about this one because you also mentioned UPS. That's also been an underperformer year to date, worse than FedEx. Is that the reason you picked FedEx over UPS, or does it also have to do something with, for instance, the labor costs that affect UPS?
I think it's that end a bit more. I think in terms of valuation, we think FedEx is more attractive at this particular point. We looked at UPS in the past. We didn't feel, the entire sector is under pressure right now. So we didn't feel that UPS had the same opportunity to grow at this particular point. We think that the processes and the stock price at this particular point had been pushed down enough to make it more attractive, in our opinion, as a value play.
Okay, and then let's talk about the final name on your list. You've got Altria on your list, the artist formerly known as Philip Morris back in the day, so dating myself here. It's been an outperformer. I didn't catch this one compared to the S&P 500 year to date. So what's your view on where it goes from here?
Diane, I'm like you. I still think Philip Morris. And Altria is one of these companies that everybody underestimates, but it is one of these companies that continues to be a solid performer. Excellent dividend. Right now, the stock has much room to grow. We're looking for a double-digit increase, probably around 7% in the next 12 to 18 months. It's one of these resilient companies that continues to overperform and do well in good and bad markets. And we talked about a flight to quality. When the market goes south, a lot of people put their trust in stock into Altria Group, which we believe going forward can do very well. They're also developing new products, new solutions that could be very attractive and are starting to make impact worldwide. So this is just one of the reasons. We also believe that with the growth and with the solid dividend, this is a very attractive stock to own in your core portfolio, Diane. So you want to be an owner of this. You want to have it in there. Despite what the social connotations are saying, you want to have this stock as part of a core holding, in my opinion.
All right, Rick, let's talk about this chart. What do you notice about the technicals for Altria?
Yes, as you guys said, a significant breakout here. We can see that for a while we were stuck around this area here near 60 or so, not really making too much progress. Beyond that point here, you can kind of see, depending on where you draw it, 60, 61 or so. But kind of like our last chart, we had this period of shrinking volatility, in this case more of a triangular shape. And this is what I mean when I say low volatility can be the precursor to high volatility. When one of these established boundaries does get broken here, you can see this was the breakout point. We left our old highs behind significantly here. We topped out yesterday, 66.29. Today, giving back a little bit of those gains here. So now the question is, do you look to perhaps, if you had a bullish outlook, would you be looking to buy on the pullback, or would you be looking to try to capture new highs when the breakout comes to the upside once again here? That's kind of the question you have to figure out if you did have a bullish perspective in this name here. So we can see that RSI remains in the overbought area, that threshold above 70 here, despite losing a bit of ground in terms of our price action here. If we were to add our other studies, we can see that not too terribly much volume in recent weeks. Its price hasn't really had much time to stay in a general area and accumulate trading activity here. But for starters, we could see the little node right here around 62 matches up with our yellow 21-day EMA. That seems like a point some traders might have their eye on. We have our point of control a bit lower here near 59, kind of centered almost within our symmetrical triangular area of consolidation there. So some downside areas to consider there. To the upside, +2 standard deviation channel comes in around 68.44 or so if things do continue to rise. Remember, this is a snapshot of this moment in time. It would be a moving target going forward.
All right. Thank you, Rick. That's Rick Ducat, our lead market technician, and Aquiles Larrea of Larrea Financial. Thank you so much for both of you all for being with us.